opportunity zones.
Cash value life insurance policies?
Cost segregation?
Oh my.
That's what we're talking about today.
Welcome to the Utah Real Estate Show podcast, the show where two agents and a lender teach real estate best practices by talking through mistakes we've seen and made.
Let's say they wanted to sell a property that they're ready to sell, and they'll sell it. They'll take $500,000, put it into the policy, and that's a complete corporate tax write-off. They can write all of that money that they put into the policy,
even if there's gains,
as a write-off, even if there's gains.
Hello and welcome to another episode of the Utah Real Estate Show. I am Tyler Kazare, Utah Real Estate Agent.
Jason Christiansen, mortgage lender.
Eric Wist, Utah Real Estate Agent. And today we have Alex, the rockstar financial guru. Every positive name you could think of right here, where he's going to teach us some stuff today.
Tell us a little bit about who you are, like your qualifications.
So I started my own financial advisory firm about 8 years ago. It's called On the Ball Financial. Mm-hmm. And when we originally started it was pretty broad. The people that were retiring and wanted to make sure that their money was taken care of, and the people that were just starting out, and business owners and all of that. But about 5 years ago, I had the opportunity of working with a couple of clients that wanted to look for alternative ways of building capital and saving money to get into real estate investing and have that opportunity and start building passive income that way. And I really loved it. I really loved learning more about the different things that we could do and the different strategies and the different tax strategies. And so for the last couple of years, that's really been my focus of what we've done at the firm, is helping people that maybe want to do things a little bit differently, or maybe take advantage of some tax strategies that aren't as well known in the industry as they probably should be, and help them take advantage of those things so that they could, buy as much real estate as they can and really get to where they want to go.
Awesome. So we have a lot of our audience who are either newer investors or maybe have some questions. Like I own, I don't know how many doors I own, like 7.
So many
appendages.
I own
still less than 10.
I own some properties, guys. I don't own a ton of properties.
The thing that stood out to me right away, which I hope people caught, was you talked to some clients that wanted to generate passive income.
Yes.
And move forward with that. And that was, to me, that was kind of my game changer of understanding, like, hey, passive income, that is awesome. But then you said the second part, how to gain other capital that you have or have access to gain even more. And that I want to hear some more about.
One of the things that I've totally seen as I work with business owners and real estate professionals and all those kinds of people is that you have kind of two kinds of business owners. You have the business owners and the investors who are really that are really deep into what they're doing. Like they own a business, but they're doing it, right? They own a flooring company, but they're working every day doing flooring.
Which is by definition not passive.
It's very
active.
And then there's those people that kind of, it's like a light bulb kind of clicks on, and they're like, I have some money, and if I'm smart, I can use this money to make a whole bunch more money without having to put in the effort. And if I'm smart, I can use this money to make a whole bunch more money without having to put in the effort. If I can make some smart decisions and I can learn what I got to do, my money can make money, and then I don't have to make money with my hands anymore. And that's what I love helping people do.
How do they do it?
Yeah. So
I'm sure there's just one answer.
Yeah. So there's a couple strategies that I really like to go over with people. Using life insurance as a way to generate the capital needed to get into real estate.
So what type of policy do they need? Who can typically use this? When do they sign up for it?
So there's a couple policies that you can build cash value in. I always recommend that you do something called an indexed universal life policy. When people think about cash value life insurance, the first thing that really comes to their mind is whole life insurance, right? That's been around for a long time. It's something that people have used. You hear about like the guy who started KFC had a whole life insurance policy that he used to start the business, right? And it's just something that people have done in the past. Index Universal Life was created in the early 90s, and there's a lot of things within Index Universal Life
indexed
policies.
on what?
So it's invested into an index. That's one of the reasons why it's called an index. So you can, sometimes it's invested into the S&P 500, which is an index, or sometimes it's invested into other indexes that the life insurance company has created themselves. The reason why it's called a universal life policy instead of a whole life policy is because there's a flexible premium. With a whole life policy, you have to pay the same amount every single month, and there's no flexibility there. With an index universal life policy, you have a minimum that you need to pay to keep the policy going. You have a maximum that you can pay, and if you go over it, you lose all the tax benefits that you get, but then you can go anywhere in between there. The reason why I like cash value life insurance for real estate investing, there's a couple of reasons. Number one, with a cash value life insurance policy, if it's built correctly, the fees over a long period of time are less expensive than an IRA or 401k. It's blind to the IRS, so a lot of the red tape that you run into when you have like a self-directed IRA and you're using that for your real estate investing, 1031 exchange, if done correctly, 1031 exchange laws almost don't matter anymore. Once you get to a point where the policy is big enough, and you can be very, very flexible.
Does the policy own the property, or does the individual own the property?
The individual owns the property.
Okay.
What you're doing is you're taking the money out of the policy to then either put like a down payment on the property or to buy the property outright. Yeah. A couple of ways that people have used a cash value life insurance policy in the past. There's to do this. There's really two ways. It's meant for people that can at least invest $1,000 or more a month.
Okay.
It needs to be a bigger policy.
Okay, so this is not necessarily for your first-time home buyers.
Not necessarily, but you'd be surprised how many young people that are first-time home buyers are actually making pretty good money and can invest that much. But yeah, you need to have some money that you can invest. It needs to be at least $1,000 a month. And if you do that, within the first 2 years, you're going to build up enough capital where you can pull out tax-free, penalty-free income, and you can use that.
For what use? What are the specific uses that can go towards?
Anything. You can use the money for literally anything. Some people will use these policies to pay for their business expenses. Some people use these policies to get into real estate. Sometimes people use these policies to buy a company.
Does it fluctuate with the market? So you could have massive gains or losses?
So that's one of the things that I love about an index universal life policy is that it doesn't fluctuate with the market. The floor on these policies is 0%. So on the years that the market does really, really bad, you're guaranteed a 0% return. You don't get any negative ever. You never have to worry about negative years. And then depending on the life insurance company that you use, sometimes there's a cap on the good years. Normally, if there is a cap, it's 13 to 15%. So if the index that you're invested in goes above that amount, then you're not going to be able to get those gains past that number. But with the companies that I've been working with recently, companies like Nationwide, for example, they don't have a cap at all. You can make as much money as you want just depending on the market. And within the index, the way that they do it is it's actually a 220% participation of it. So let's say the index does 10% that year, they're going to credit you 22%, and you're going to get 22% for the year. So there's some really cool
There's
things
some
you
cool
can
ways
do.
to get into
You're
it.
protected from downside market loss. You can use that money. But then the other cool thing, so what a lot of people have done is they go and their policy is connected to their business, and their business is paying for it. So then, let's say you take out $500,000 and you go buy a property, right? Then you have $500,000 of tax-free space that you've created, because that's space that you can refill back. So then they'll take another property. Let's say they wanted to sell a property that they're ready to sell, and they'll sell it. They'll take $500,000, put it into the policy, and that's a complete corporate tax write-off. They can write all of that money that they put into the policy,
even if there's gains,
as a write-off, even if there's gains. And so the corporate tax write-off is 22.5%, which is right about where the capital gains tax. You're pretty much canceling your capital gains tax.
The best thing, like I like having you here, is when you start playing in bigger pools and bigger deals, you're dealing more with, like you just said, taxes. You're dealing with how to move stuff around, how to do it legally, how to take this do this. It cancels each other out, not getting in trouble. And that's where you end up making a lot of money by moving stuff around. And I think you mentioned earlier cost segregation. You mentioned that to a lot of people and it just goes right over their head.
They're fun words to say too, cost segregation.
It is fun to say.
And a lot of accountants. Right over their head.
I talk to CPAs all the time, and they're like, or they've heard of it and they don't know what it is, or they've never even heard of it.
So let's tell us fourth grade level
for the basic people out there,
and me,
and for Jason and me and everybody. What is a 101 definition of cost
segregation? You go and you purchase a residential real estate property. Right? When you go and you purchase that property, if you just let it depreciate normal, the way that it depreciates, right, where you get to write that off on your taxes, 27 and a half year period of time,
correct.
Right? If it's a commercial property, a 39-year period of time. Most people, and I bet you guys have seen this in what you've done, do not hold the property that long, right? Almost never do people hold that property that long. In a situation like that, you're losing opportunity to take advantage of some of the tax savings that you could have taken because you're going to sell the property before you take advantage of your full depreciation. So cost segregation is this. What you do is instead of just taking 27 and a half years of depreciation or 39 years if it's a commercial property, is you take the building and you separate that building into different assets. So for example, the carpet depreciates faster than the building of 27 and a half years. The whole electrical of this building depreciates faster than that 27 and a half year period of time. All the office furniture in this building, all of the doorknobs and the doors, anything that isn't the bare bones structure of this building that we're sitting in right now can depreciate faster than the bare bones building of this being a commercial property, 39 years. And so what you do is you can separate that all on your taxes, and you can take a whole bunch more of depreciation faster. That can help you save a whole bunch of money on income tax. If you're planning on buying other properties, you need to make sure that you can qualify.
Actually, I don't care about depreciation. I add it back in because it's not a real expense. Yep.
Really? I didn't. Oh.
So segregate the crap out of it.
Okay, cool. That's awesome. I've ran into other mortgage professionals that
don't know what they're doing.
I guess. That's awesome. That's something that I learned. That's super cool. Great. So then don't worry about that. So that's the basic idea of it, is you can take depreciation a lot quicker.
And one of the questions I know people are going to have, but like you said, most people don't own it that full years. So I buy a 10-plex apartment building, cost segregated out, and 4 years later I want to sell it. Well, do I owe any of this depreciation that I already wrote off for 30 years up front?
No.
You gonna exchange it? Are you familiar with the 1031 exchange?
Well, yeah. I was just, because that's one that every class that I've been in, there was like, well, how do I take 30 years of depreciation and then turn around and sell it in 2 years and not owe anything back?
So the thing to remember is that,
like, is there a bad time to do it?
It's not like you're taking extra depreciation. That part of the building depreciates at that speed.
Gotcha.
Do you see what I'm saying? You're not taking extra depreciation. You're just saying this part of the building depreciates faster. I'm going to take it at the speed that I can take it. Does that make sense? So you're not having to pay anything back.
And you can just do that. Well, how many times can you do that?
On a property?
Yeah, property.
So the owner of the property can do it once.
Okay.
So I've seen it where somebody is selling a property. Maybe they've only had it for 5 years, and so they do the study right before they sell it. They take a bunch of the depreciation, and then somebody buys the property, and they immediately do a study again. But because it changed owners, that they were able to do that.
So one time per owner per property.
Yeah. Not all cost segregation companies are made the same, obviously. So it's just important to make sure that you're working with a company that knows.
So how do you vet a company? Say I'm purchasing a property in Indiana, which all my people on the podcast know that I buy a lot of property in Indiana.
Yeah.
How would I vet a cost segregation analysis study company?
Yeah. So with every single company that does cost segregation that I've seen so far, what they'll do is they'll offer a free cost segregation analysis where you give them the property that it is, you give them the address, you give them some of the specs of the building and things like that. And they can actually go and get some of the records from that building, and they can give you a really pretty accurate cost segregation study of what they're going to be able to do once they actually get in there and do it. And so that's the best way to do it, is just go to a couple companies, get a cost segregation analysis, and then based upon the analysis, make your decision. The company that I always use with all of my clients is a company that's here in Utah, that's in Pleasant Grove, called Cost Segregation Authority. They've been around
name before.
Yeah, they've been around for a while, and they're very, very good at what they do.
And do they service all states or only Utah?
All states.
All states. Okay.
Every single state.
So we just go down the street to Pleasant Grove, guys.
Yeah.
And talk to those guys. And
Well,
they'll take
cost
care of us.
segregation, that's another one that, I mean, I've been in classes that have been 3 hours long on just cost segregation, and that's another one. Talk to them, find out some more, learn about, see if it qualifies for what you're wanting to do, if it makes sense to do.
Yeah.
Is there ever a time you wouldn't do a cost segregation analysis? When
if
is
you've
a
owned the
bad
building
time?
for a really long time.
So
Like if you've owned the
you've
building,
already completed 20
yeah,
years.
26 years.
If you've owned I'd say if you've owned the building,
Everything's depreciated.
if you've owned the building for more than like 10 years, then it maybe doesn't make a ton of sense, because
You're just preloading
the faster,
depreciation.
and the faster assets are split into 5-year, 7-year, and 15-year depreciating assets. So if you've owned the building for like 10 years, there's not much
You've
more
already
that you
kinda
can
spent
take.
it.
Or if you plan on owning it for 30 years.
Can you do it on your primary residence?
You cannot. No, it has to be an
I knew that
investment
question.
property.
One of you guys
No.
can
Yeah.
ask
Yeah.
It
that.
has to be an investment property.
I've heard a
Yeah.
lot of investors say, I won't do this on a fourplex or less. I will only do this on
I
fourplex
think that's
or up.
completely false.
'Cause you
I
can do
think
it on
that's
anything.
a mistake.
Yeah.
It's gotten a lot less expensive. The reason why people said that is because there is a cost to obviously getting a cost segregation
Right.
study done. And it used to be to the point where, like if it wasn't like a really large building, that it just, the cost of
didn't make
doing
sense.
it wasn't much worth the tax savings that you were
Do
going to
you
get
have
in the
to
long
do the
run.
study to take a cost segregation?
Technically, I don't think you would. I mean, it's just within the way that you submit your taxes. But if you don't know what you're doing, they're gonna deny it, and they're gonna
Ouch.
send
That would
it back, and they're gonna say, no, you can't actually claim this. There's some really specific rules that you have to follow within cost segregation.
If you have a handful of properties, how many would you segregate a year?
All of them, if I could.
Well, because the tax savings, from what I understand too, it keeps rolling over.
yeah. So
So if you don't use all of that the first year, you roll it over to the next year.
So let's say you have a huge
next year.
Let's say you have a huge property, and or you own a whole bunch of properties, and you do cost segregation on all of them, and the tax savings are so much that you actually bring your income tax to zero for that year, and there's a whole bunch of tax savings that you didn't use. It just keeps rolling over until it runs out. And so I would just cost segregate.
Genius. Like, do it
everything.
all.
Yeah, he is.
Okay, opportunity zones.
Okay, so real quick, opportunity zones and the way that they connect to cost segregation. So first of all, opportunity zones. The idea is that the government is trying to get certain parts of certain states, right, and people to invest in those parts of those states, and to buy real estate, and to get companies, and to make things start happening in those parts of the states. And so what they do is they say, this area of this state is an opportunity zone, and there's different cool benefits that go along.
How do you
with.
find an opportunity zone?
So there's you can just Google it, and there's
Okay.
maps. There's maps all over the place that show the opportunity
Okay,
zones.
so you
and
buy a
where they
property in
are.
an opportunity zone.
So if you buy a property in an opportunity zone and you do a cost segregation study, right now you can take something called 100% bonus depreciation, where everything that fit within the cost segregation study you can just take in 1 year. You don't have to, it's not like carpet in 5 years, so you get to take the carpet in 5 years. You could just take everything that fit within that study and just take 100% bonus depreciation within that year, and then have that carry over if it's too much and your income goes to zero.
Good tax savings.
Wow. Yeah.
Yep. So some
That's
cool
awesome.
stuff for people to save some money and have the opportunity to have more money to go buy more properties.
Let's go
yeah.
over what we learned.
Yeah.
Well, my key takeaway is I need to go do a bunch of cost segregation analysis on my properties because I think I could reduce my income to zero.
I like using life insurance to fund the purchase of properties. Oh, that's pretty cool.
Awesome.
I think to remember that there's so many different ways to get income and to move it around to create that bigger passive income. And as long as you have that goal by talking to different professionals around the industry, you're going to learn some really cool tricks.
And I learned that you can do that. You don't have to worry about qualifying.
Depreciation.
You don't have to worry about the depreciation and qualifying for other properties. That's awesome.
So, Alex, thank you. Cost segregation, cash value life insurance policies, opportunity zones.
Yeah.
Good stuff.
This is episode 1.
First part. Next time we're going to talk about more stuff. So subscribe. Hit the little ding bell when the next episode comes up.
And ask some questions in the comments, which ones you liked it. We had some controversial stuff going on today, so tell us what you think about it.
Yeah. See you next time.
If you want to get in touch with us, shoot us a text at 801-228-7687. Make sure you mention the show. You can email us at theutahrealestateshow@gmail.com. You can watch this show on YouTube, and you can listen on Apple Podcasts, Spotify, or wherever you get your podcasts. If you learned something, or if you really love this show, give us a like on YouTube and drop a rating on Apple Podcasts or wherever you listen. The Utah Real Estate Show is a production of Hive Collective at Presidio Real Estate with support from Security Home Mortgage. The NMLS number for Security Home Mortgage is 178787. The NMLS number for Jason Christiansen is 240472, Equal Housing Lender. Not only is this not legal or investment advice, but you should definitely talk to a pro before you make any real estate decision. Every situation is different and should be considered in context. Copyright Jason Christiansen, Eric Wist, and Tyler Kazare. All rights reserved. Talk to you next week.
Response to some text really quick. Are we going to start?
Well, we're recording.
All right.
I'm just saying. All right. Into camera, which is that. Yeah, whatever.
So I have a life insurance policy, but I don't have down payment. Is there an opportunity for me there?
Yes, if you segregate it.
That's what
Oh,
we're talking about
geez.
today.
Okay, there we go. What am I saying? What's everybody saying? Are you saying,
Oh
oh
my.
my?
That's what we're going to talk about today.
And there's an opportunity zone to mash the like button.
What?
Luke, like, subscribe, call to figure out where you're going to go
Was that a sentence?
in life.
What was that?
I think it should be the sub